I'm Edith Bovay. I am the Director of Agriculture for the province of Alberta. So today I'll be talking to you about the finances that is involved in farm transfer and how we can prepare for them. So farm transfer is a very complex procedure. It's not done overnight. It has very different aspects to it. It has the family dynamics. It has the ownership dynamics, financial viability. There are tax considerations associated also with the legal considerations, and also we always have to take into consideration the economic landscape. So economic landscape refers to increases in interest rates, bad weather, fluctuation in market prices, etc. So with all these different aspects, of course, this requires a lot of time and patience and resources. So resources, we refer to people like myself and Samantha. And above all, we want to make sure that all the parties within the farm transition are heard and their needs are met. So a farm transition, a farm transfer, what is it? It can be considered at either a purchase or transfer of an agribusiness. It can be a related, partial, or complete succession of shares or assets. There are two forms of taking over the farm. There is unrelated, partial, or complete transfers. There's buyout of a member or a shareholder who leaves the company. Partial transfer, so we can consider a transfer when a new shareholder buys a minimum of 20% of the shares. There's purchase of balance of a sale of a few years after establishment, or even in more rare cases, a startup of a business. Before we go into the financing products, we always have to establish what is the financial viability of the farm. So it is very important that you take minimum a 3-year historical performance, usually with your banker. You look at what went wrong, what could we have improved, what went right, what did we do right, and see if it was very stable or fluctuating history. If it's very fluctuating, we need to make sure, is it because of the weather? What are the causes of those fluctuations? Is it because of the weather? Is it because of unexpected events such as diseases? Or is it maybe there was an unexpected event in the family, which then the workforce is not the same? After that, we also need to finance the assets in accordance to their lifespan. So for example, land, usually the lifespan is land is eternal. So usually amortization on land is 25 years. You have to assess also the age, let's say, of equipment. If it's an old equipment, usually it's going to stay around 5 years. New equipment is going to stay around 10. Then you take into consideration the maintenance, the repairs. So it's just to assess the value of all your assets, their lifespan, and if they are productive assets. Are they going to generate you revenue directly or indirectly? Afterwards, once assessing the historical performance is, okay, what are the financial projections? Is the farm going to perform as usual, or are we going to make improvements to generate more revenue, to reduce the cost of production? And then lastly, we'll be establishing flexibility. So once you have a loan structure, financing structure in place, are we able to meet those payments? Why would we not be able to meet those payments? Is it because of disease, poor weather, poor production, price fluctuations in the market? So it's very important to have some room for maneuver if something goes wrong. I'm quickly going to go over the 4 categories of financial performance. They are divided into 4. It is liquidity, solvency, profitability, and financial efficiency. Liquidity is very simple. Is there money in the bank? Maybe not as simple as that, but is there money in bank? Is there inventory, such as grain or cattle, that you're able to sell right away to reduce your line of credit, to pay your account payables, to pay the last year's fertilizer, pesticides, and make your loan payments? Solvency is another big financial aspect that we look at. Solvency refers to equity in your business. Equity is the value of your assets minus the debt. It is important to have, I would say, at least a 50% equity if ever you want to finance other assets that are not going to generate you some additional revenue, or you need a cash flow injection at some point because of bad weather or just an unlucky year. That additional financing that you will obtain will be similar to an equity takeout. So then afterwards, the project, your equity will diminish. Profitability refers to the profitability of your assets. For example, milk quota. Milk quota, we know, generate instantly revenue, but a tractor doesn't. Okay. We need to know if your farm is profitable enough to make loan payments and profitable enough to make to invest in additional projects. Last but not least is financial efficiency. Financial efficiency, usually I do refer to the cost of production. So are all the inputs that you use to generate that revenue, are they efficient enough? For example, if you have too many equipment rents and they're costing you money and you don't use all of them, maybe you should sell a few of those just to reduce your cost of production, maintenance, and stuff like that. Something to consider, I did talk about the different parties in a farm transfer. So usually there are two main parties. You have the new generation coming in who wants to take over the farm or does not want to take over the farm. And you have the actual owners, who are usually parents or other members of the family. So during the farm transfer, of course, usually a new generation doesn't just go onto the farm and continue farming. We usually have projects, we want to make improvements, changes, make it our own. And also, well, we want to live off the farm, so there's going to be additional salaries. Are we going to need a house for ourselves because we're renting actually? Are we going to want to buy a house? Is it the farm that's going to finance it? Is it not? On the actual owner's situation. So, okay, we have this new generation coming in. We need to generate a new salary for them. Do we want an additional, a greater salary to take on some retirement projects? Do we otherwise just want to sell our shares for a certain amount and get out? So you have to consider both parties, because both parties' decisions will affect the financial portrait of the farm after transition. So I'm going to talk a little bit more about the loan structures and products that we offer here at National Bank. Now, number one would be a capital moratorium. So capital moratorium really does mean you pay interest only. Ideally, would be paying interest on part of the loan. It is very important to continue to pay capital on what you can pay at a certain point in the transfer, simply because that then creates more equity on the farm. Then the AgriFlex financing. It's a very flexible product. It starts off with a line of credit. So a line of credit is not for your current operations, okay? It is a line of credit that is for CapEx that you buy during the year, capital expenditures, or any additional cash flow that you need. So that can be used also for farm transition. It's viewed also kind of like a cash flow, and it's not a cash flow injection, but an equity takeout, and you pay interest only on that. Now, the rest of the financing that you already had in place prior to the farm transfer, they can be in forms of term loans or we can also look at interest only. Now, the interest only part, what's interesting about this, if you're in a healthy financial position, is that it creates additional cash flow for you. So of course, you're not making as many payments or as big payments as you're supposed to be, but that is supposed to, the money you're not taking to make payments, that money is to invest in your farm, is to pay all your account payables, to lower the debt on your lines of credits, stuff like that. The other option is 100% land financing. So 100% land financing, what we do is we can finance land up to 30 years. So within that 30 years, the first 5 years are going to be interest only. Same principle is to build that additional cash flow for the farm. Of course, the situation is reviewed every year to make sure that the farm is going in the right direction. After the 5 years, we take that loan and put it on amortization, 25 years, capital and interest. And it's not necessary for you to put a cash down of 25%. Usually land is financed at 75%, so the extra 25%, it's not necessary to have 25% of that, which a lot of us, usually we don't have that sum available. So we take additional security or assets that may be available on the farm to bridge that gap of the 25%. Now, last but not least, there is a 15-year quota financing. So quota for chickens, turkeys, and dairy. So usually a industry standard is 12 years amortization for quota. In this case, it would be 15, and the lending value instead of 60% would go up to 70%. Now we're going to go over a case study. It's a very simple case study, but it can become very complex if the right things are not done, if the right things are not put in place. So if we go to the case study, there is Bob is a widow farmer, grain farmer. His wife, of course, passed away. He has no debt on the farm. The farm is worth $4.2 million. He has 2 children, James and Sue. James has no interest in farming. Sue currently is married to a neighbor farmer and would be interested in taking over her father's farm. So what do we do? Of course, James wants his half of the farm, which would be $2.1 million. Therefore, Sue gets the other half, and Sue has to pay James the $2.1 million. The problem here is that the farm generates about $100,000 in profit every year. If we take $2.1 million on 25 years, because most of the assets is land, the payments are going to be much greater than the net profitability generated by the farm. Therefore, what we do, before I go to the structure, Sue does have some real estate that she owns and some savings on the side. That totals about $1.25 million that she has in equity. Okay, so we said James would have to, James wants $2.1 million. So Sue, since she does have $500,000 in savings, she is going to put a cash down of $310,000 there, which is worth 15%. We are going to take the balance, $1.1 million, divide that. 1/3 of that is going to be on interest only for the first 5 years. And then following that is a 25-year amortization on $600,000. The balance of 1.2 automatically goes into repayment, 25 years capital and interest. So if you look at the chart a little bit below, I do apologize. The months mentioned there's 99999. Do not take into account that. That's just my way to calculate interest only without capital. So 600,000 interest only, that's about 24,000 per year. And then the balance of 1.2 would be a $76,000 of payments per year with a total of 100,000. So if you remember, I did say the farm had a net profitability of $100,000, and with these payments here, the farm is able to make their payments. Of course, Sue is not able to take a cost of living or a salary for herself. However, she does have a job outside. She has her husband who is a neighboring farm, so for the moment that is not of a concern. So then we have our recommendations. It is important why we choose this structure is that we want the farm to build some cash flow, like I mentioned a few times already. So the 5 years does represent a 16,000 decrease in payments. And why do I say that? Is because the $600,000 loan on interest only, payments interest only are $24,000, but once they become into repayment on 25 years, those payments become $40,000. So in total, that would be $116,000 of payments per year, which the farm with $100,000 of net profitability is not able to meet. Therefore, Sue has 5 years to build that additional cash flow, to make improvements on the farm, because we don't know if the farm was in a good, had good management of the crops, low cost of production. We don't know. So there may be a lot of improvements there to do. I'm going to mention Plan A. Like I said, the client does use $300,000 of her savings for the cash down, which if she did not have that, probably we would not have been able to make the financing. Or there's two other options. They either would have had sold the land, Sue would have gotten her part, 2.1, and James would have gotten his part there too, but she would have let go of the farm. And then there is some equipment on the farm that she found that was of no use. So that's why it's also very important to evaluate the assets of the farm. Are they productive? Are they non-productive? Do we need them? If we don't need them, why not sell them and use them to reduce your long-term debt or use as cash flow? Plan B, other than just putting in $300,000 of savings that she had, she could sell some of her personal real estate and inject that equity into cash flow, or to lower her debt of from 1.8 to, let's say, I don't know, 1.5, 1.4. The payments obviously would have been much lower. So the takeaways in this is that Sue had equity, and that's very important. When you don't have that additional equity, it's very hard to plan a loan structure. You need, in this case, we would have maybe looked at taking additional security from her husband's farm. But then again, we don't know, does her husband's farm have enough debt-free assets? And something else that we did not talk about, if you maybe realized the father had no life insurance. It was just, when I pass away, the farm is sold, and then it goes to my 2 children. So if he had some type of life insurance, let's say even $500,000, that $500,000 would have gone to the 2 kids, $250 each, and that would have made the potential cash down for Sue to purchase, to pay out James. So that is something that would have been very important to have. Luckily for them, Sue did have the additional equity on the side for her to take over. So then, in conclusion, it is very important to understand the needs of all the parties in this transfer. Just like in my case study, there was no talk of transfer. The father passed away, and then we have to make a quick decision. What do we do? Before that, before anyone passes away or an unfortunate event happens, it is very important to understand what each other wants. These needs do change over time, but this is why it is very important to talk about this. It is very important also to establish the historical performance. Is the farm performing well? Is it not performing well? What can we do to improve it? And how much more new debt can we take on if we don't change anything? Okay. Like I said in my case study, savings are very important, so it's never too late to start a plan to make savings. This is why we have financial advisors like Samantha who can help you for those investment strategies. Something that I maybe just touched upon is to evaluate the market value of the farm and the economic value of the farm. So the difference is, okay, market value is how much can we sell the farm for. The economic value is how much can the farm generate as revenue. How much debt can it take on? It's a very different way of seeing the value of the farm. New generation does not want to take on a farm that is indebted, that has troubles, and there's little room to make improvements by investing new capital into it. Okay, it has to be in a healthy situation prior to any transfer loan structures. Financing, sorry. And lastly but not least, as I mentioned, engage your appropriate professionals early in the transfer process for a successful transfer. Thank you very much for your participation.
Thank you very much, Edith. I'm hoping everybody can hear me okay now. I've had some comments that my volume was bad. So if it is still bad, just if you can write in the Q&A again, and I'll try and get that fixed. But if not, I'll just carry on here with the questions. So Edith, for you, I do have a few questions. First one here, what is the criteria for clients to be eligible to these financing programs? Maybe I'll just go back to that slide so they can just see the four. Here we go.
Yeah, so there is no set criteria. As I've mentioned, it is very important for the farm to be financially healthy, for them to be able to pay their current debt, to have some surplus cash flow, to take on any new project, whether it is a land purchase, whether it is a farm transfer. They need that additional surplus to take on those new payments. Okay, doesn't matter how big, doesn't matter how small you are, or in which production sector you are, it is just very important to be in a healthy financial state before taking any farm transfer financing decisions.
Okay, perfect. Thank you, Edith. Another one here. When should a client be talking to a banker about their transition? What is the ideal time?
There is no ideal time. It can be as early as 10 years prior to when your kid is going to be 20 or 30 years old, or prior to when your kid shows any interest. For the new generation, you can go and talk to your banker about your concerns overtaking the farm, what you want to do, what are your projects. And then banker, well, myself, I'm going to ask, well, okay, are you involved in the everyday chores? Okay, have you seen the bookkeeping? Like, in which sectors of the farm management have you seen? It is very important for the new generation to understand that it's not just the cropping or the caretaking of the animals. It is the marketing, it is the bookkeeping, the financial aspects, and even to some point the human resources, because most farms now do have employees. Yeah, so it's very important to look over all those aspects and ask those questions, and also to look over your banker. Well, is my farm in a healthy financial position? What can we do to improve it? You know, can we stretch out amortization? Is it going to be on the revenue side, the cost of production? Can we bring in maybe a farm consultant to improve, to look at, to have some opinions? And also, well, okay, for any type of project, doesn't matter what, if it's a farm or buying a house, do you have savings? What's your plan? Do you have a plan? And it doesn't matter how many times per year you contact us, we're always happy to talk to you. The more you talk to us, the better the working relationship is too.
Great, thanks Edith. Just another one here. I'm just wanting to get a little background on Edith, where she comes from, and also the team behind her and professional programs available as they relate to vets and that sort of thing.
Okay, so I'll talk a little bit about myself. So I've been here at National Bank for 6.5 years. I went to McGill University in agricultural economics. I have my agrologist title. So I started off as an intern at National Bank just outside of Montreal on the South Shore. I quickly got into an account manager position. I had about 120 clients, all in dairy, cash crops, and a little bit of produce. After my 4 years, I decided to replace a maternity leave in Ontario, not as an account manager, as an analyst. So what I did, I wrote the credit for at least 10 different account managers across the province, from London, Ontario to Belleville to Ottawa. So all different geography of the province. And it's been about 1.5 years now that I am in Alberta. I do have, as you know, a very heavy portfolio and experience in the dairy sector, cash crops, grain crops, of course. I am quickly learning everything that I can about the cow-calf sector. And yeah, that's a little bit about my background now. My team, I am situated in Calgary. I do cover from almost the whole province, so Lethbridge, Medicine Hat, Calgary, Red Deer, Edmonton, and a little bit up north Edmonton. However, I am in Calgary, so I prefer meeting clients in person. I know we are in a COVID situation here, but without COVID, I want to be able to come and see you as much as I can. So I do travel a lot to go and see my clients. I want to go and see them at least every 3 months minimum, or hear from them. Of course, it's always better to see you guys. I'm a very visual person. You're able to show me things, or things are not said on the phone. It's much better in person. So that's yeah, that's my background and my territory and the sectors I work in.
Great, thank you so much, Edith.